In the late 1990s, the world witnessed one of the most dramatic financial manias in modern history, a moment when the internet turned from a strange technological experiment into the most thrilling economic opportunity people had ever seen. Investors, entrepreneurs, students, and even ordinary families believed that the internet was about to rewrite every rule of business and create limitless wealth. Technology conferences were packed. Newspapers called it the new economy. Financial channels broadcast non-stop coverage of rising tech stocks. Anyone who could register a web domain suddenly believed they were on the path to becoming a millionaire. The Nasdaq Composite Index, the heart of the technology sector, soared from around 1,000 points in 1995 to over 5,000 points by March 2000. This stunning rise created a wave of optimism so powerful that many people convinced themselves that profits, business models, and fundamentals no longer mattered. All that mattered was being part of the internet revolution. But beneath the excitement, the foundations were dangerously weak. Many companies had no revenue, no customers, and no working product. Yet they were valued at hundreds of millions of dollars. The world was racing toward a financial explosion without understanding the risks that were building beneath the surface. The beginnings of this bubble came from the early evolution of the internet. Before the 1990s, the internet was mostly used by researchers, universities, and the government. Everything changed in 1991, when the National Science Foundation removed restrictions on commercial use. Suddenly, private companies were free to build businesses on this new digital platform. In 1993, the Mosaic browser made it easy for everyday people to explore the web with simple clicks and graphics instead of complex text commands. This accessibility led to an explosion in internet adoption. Between 1993 and 1997, the number of websites grew from a few thousand to more than 1 million. Early pioneers like Amazon, founded by Jeff Bezos in 1994, and eBay, created in 1995 by Piero Migliar, demonstrated that online businesses could scale rapidly. Their success attracted a stampede of investors and entrepreneurs who believed they could copy these models. Venture capitalists invested billions in internet startups, hoping to discover the next Amazon before anyone else. These early successes convinced the world that the internet would dominate the future economy, and that investing early was the only way to get rich. This belief became the fuel for a massive financial bubble. By the mid-1990s, Wall Street analysts embraced the idea that traditional methods of valuing companies no longer applied to internet startups. For decades, investors evaluated businesses based on earnings, cash flow, and long-term profitability. But during the dot-com boom, many analysts argued that the internet was so revolutionary that profits were irrelevant. Instead, they introduced new metrics such as number of users, website traffic, and future potential. This shift opened the door for companies with no profits to achieve astronomical valuations. For example, Netscape Communications went public in 1995 and doubled in value on its first trading day, despite never posting a profit. Similar stories followed. Companies simply added "com" to their name and watched their stock price skyrocket. One company, called TheGlobe.com, rose more than 600% on its IPO day. Investors were no longer analyzing businesses. They were chasing hype. Fear of missing out drove millions to invest their savings in tech stocks. People believed that if they didn't buy now, they would never get another chance to join the digital revolution. The stock market became a casino fueled by speculation rather than financial reality. The boom was intensified by venture capital firms aggressively funding internet startups, with little regard for long-term sustainability. The goal was not profitability but speed. Startups were expected to expand as quickly as possible, even if it meant burning huge amounts of cash. Venture capitalists believed that the winner in each online sector would dominate the market and eliminate all competitors. As a result, they urged companies to spend heavily on marketing, website design, and expansion. During 1999 alone, more than 37% of all venture capital funding in the United States went to internet companies. Many of these companies spent their money recklessly. Pets.com, one of the most famous failures, spent over $100 million on marketing in a single year, while generating less than $1 million in revenue. Webvan, an online grocery delivery service, invested more than $1 billion building high-tech warehouses before it had enough customers to support the business. Startups were burning cash faster than they could gain users, and the financial system continued feeding them. because everyone believed growth was more important than sustainability. A major flaw in the dot-com business model was the overwhelming reliance on online advertising. Most dot-com companies offered their products or services for free and hoped to make money through digital ads. Early internet advertising was new and exciting. Companies paid high fees to place banners on popular websites. The problem was that advertising demand could not keep up with the massive number of new websites. As thousands of dot-com businesses entered the market, advertising prices collapsed. This left many companies without meaningful revenue. Still, startups exaggerated their traffic numbers to impress investors, and analysts continued promoting them. Some dot-com firms even spent more on advertising than they earned in total revenue. A common joke during the era was that the fastest way for a startup to go bankrupt was to attract more customers, because serving them cost more money than the ads they generated. This unrealistic approach to revenue generation was one of the biggest structural weaknesses of the dot-com economy. By late 1999, the bubble had reached its peak. The Nasdaq Composite Index rose 86% in a single year, the highest annual gain in its history. Hundreds of companies rushed to go public, and the average first-day return for internet IPOs was an astonishing 71%. The financial world was overwhelmed with excitement and speculation. Analysts issued aggressive buy ratings. Television hosts encouraged viewers to invest quickly. People quit their jobs to become full-time day traders. Teenagers made money buying and selling stocks from their bedrooms. The belief that stocks only go up became widespread. But beneath the surface, warning signs appeared. Many companies missed earnings expectations. Others revealed they were running out of cash. A few high-profile mergers failed. Yet the market ignored these dangers, choosing optimism over caution. The financial bubble had grown so large that even small disappointments could trigger panic. The system was fragile, and it only needed a single spark to collapse. That spark came in early 2000. The Federal Reserve began raising interest rates to control inflation, making borrowing more expensive. Suddenly, cheap money stopped flowing into internet startups. Investors became more cautious and started examining financial statements more carefully. In March 2000, several major tech companies reported weaker than expected earnings. This triggered the first wave of selling. On March 10th, the Nasdaq reached its peak of 5,048 points. Then the decline began. Over the next few weeks, the market fell sharply as investors rushed to exit their positions. Stocks that had risen 300% in a year began falling 20% in a week. Panic spread across Wall Street. By April 2000, the Nasdaq had dropped more than 30% from its peak. Venture capital funding dried up almost overnight. Many dot-com companies had no cash reserves and collapsed almost immediately. The bubble had burst, and the economic fallout was enormous. Between 2000 and 2001, more than $5 trillion in market value disappeared. Thousands of internet companies went out of business. Some failed spectacularly. Pets.com shut down less than 9 months after its IPO. Webvan filed for bankruptcy in 2001 after burning more than $1 billion. eToys, once valued at over $8 billion, collapsed due to weak holiday sales. Boo.com, a fashion startup, spent $135 million in just 6 months and shut down shortly after launching. Even established companies saw their stock prices fall by more than 90%. Amazon dropped from $107 in 1999 to just $6 in 2001. Though it survived by restructuring, the crash wiped out retirement savings, destroyed investment portfolios, and caused widespread unemployment in the tech sector. The belief that the internet would produce endless wealth vanished. Investors were left wondering how they could have been so blinded by excitement. The financial world was forced to confront the harsh truth that the bubble was built on unrealistic expectations and unsustainable business models. Despite the disaster, the dot-com bubble left behind valuable infrastructure and important lessons that helped shape the future digital world. Billions of dollars invested in fiber optic cables, data centers, and internet servers during the boom became the foundation for today's online economy. Without these investments, services like YouTube, Facebook, Netflix, and cloud computing would have grown much more slowly. Several companies that survived the crash emerged as giants. Amazon rebuilt itself by focusing on efficiency and long-term profits. eBay continued to grow steadily. Google, which avoided the hype and focused on building a superior search engine, introduced its AdWords advertising system in 2000 and became one of the most profitable companies in the world. The collapse also forced investors to return to fundamental business principles: profitability, cash flow, revenue, and customer retention once again became the key metrics for valuing companies. The dot-com crash became a turning point that reshaped global investing. Looking back, the dot-com bubble exploded because it combined rapid technological change, widespread investor excitement, and a dangerous belief that traditional economics no longer applied. People were captivated by the internet's potential and ignored early warning signs. They believed that the future was guaranteed, and they rushed to invest before understanding the risks. The crash exposed the dangers of speculation driven by emotion instead of logic, but it also accelerated the internet's growth and helped build the digital economy we rely on today. As new technologies such as artificial intelligence, blockchain, and renewable energy create fresh waves of excitement, the lessons of the dot-com bubble remain critical. Innovation cannot replace sound financial principles. Growth must be sustainable, and hype cannot substitute for real value. Thank you for watching Retro Finance Files. If you found this deep dive into financial history engaging, make sure to like, share, and subscribe. Your support helps this channel bring more dramatic and factual stories from the past that shaped the financial world we know today.